Jim Caron is joining us now. He's Morgan Stanley Investment Management Managing Director and Portfolio Manager. Jim, it's good to see you. First of all, just to get this out of the way, we've been talking about the fallout this morning from Archegos and the unwinding of trades there, the unwinding of the margin calls there. I'm just wondering if there are any implications in the fixed income market, or if it seems for now limited to equities.
Yeah, for now it seems limited to equities, and thank you for having me on your show, by the way. It doesn't seem to have a large fixed income component to this. Really, the big impact that it had on bonds is that it made bond yields rise quite a bit as equity prices rose, towards the end of the day on Friday. But that was really it. Even credit spreads, when we look at that to start the morning, were pretty stable and unchanged, whether it's investment grade or high yield. So I wouldn't say that this is a bond market event at the moment.
Jim, do you anticipate it being a bond market? If we're seeing volatility creep back into the equities markets, do you think some of that capital will flow into the bond market as investors try to get a little more defensive here?
Well, certainly that could be the case. I mean, whenever these events happen where there's a leverage-related incident that creates some market volatility, you're going to look at the bond markets. You're going to look at money markets. You're going to look at leverage. We could also look at the second-order effects. Are there any discussions within Congress about regulation or something of that nature that comes through this? Usually, there's a flight to quality. So where we actually saw it the most was in the dollar. The dollar actually rallied quite a bit towards the end of the week. And it's just more of a safe haven flow into, if there is going to be a problem, I better have dollars. And so I think that's what's working its way through the markets right now. I don't see, beyond that, it really hasn't had as much of an influence.
Let's talk yields then, Jim. And, we obviously have seen this move upward in yields, and the market seemingly not taking at his word what Jay Powell has been saying about leaving rates lower, about inflation being an uptick in inflation being transitory. But do you think that yields kind of hover here for a while? Do you think they continue to drift higher? What's the future direction?
Well, I don't think a move up to the 10-year yield at 2% can be ruled out at the moment. Certainly that is the direction of travel that we're going in. It's just a question of how fast we actually get there. I think the range that we're in right now, which is 1.5% in the U.S. 10-year Treasury to 1.75%, is a perfectly reasonable range. I think that this is an area that puts us into place with a more dovish than expected Fed. But to your point, Julie, the market isn't fully taking the Fed at their word in that they're going to keep rates low for a long period of time. And the big test is actually going to be in June when they release their next summary of economic projections. Because remember, the second quarter is supposed to be a blowout quarter. We're looking at 10% plus growth. We're looking at million job prints, not in the next payroll report for March, but the one for April and the one for May could go up to about as high as 1 million jobs added. So it's going to be harder to keep the patient line at that point, especially inflation, the year-over-year inflation rate. If we look at core PCE, that's supposed to tick up to about 2.6%. And if you look at CPI, you might even get 3% prints. So it's going to be harder for the Fed to be convincing in June that they're going to be patient. So that's what's staring the market in the face right now. But I think once we get past this, that those year-over-year numbers are going to start to fall in terms of inflation, and that's going to make the market a little bit more calm. And I think fixed income can do better in the second half of the year as a result of that. But right now, there's a fair bit of doubt. I've got to be very honest.
There you saw the opening bell on Wall Street. Market out of the gate on this Monday morning in the red. Lots of concerns still about those, I would say, Bill Wong trades that got unwound on Friday. Shares of Viacom under pressure, Discovery under pressure. So the market will certainly be keeping an eye on all those stocks. Jim, you mentioned a jobs report and potential for very strong job gains. This Friday, we'll get a jobs report that may show close to 700,000 increase in non-farm payrolls. If that print does come in about at 700,000, where do you see the 10-year going?
I think that's very, very much in the price. And what I would say about this Friday's job number, even if it comes in around consensus around, like you said, 650 to 700,000, you ain't seen nothing yet. wait till those numbers reach up to, I think, could be as high as 1 million jobs added, because we're still dealing with some of the bad weather effects, through March that are going to keep people out of work, especially in the construction related industries. So look, I think we need another catalyst, right? So I've mentioned a series of good data points that are likely to come up, whether it's stronger jobs, whether it's very, very strong GDP prints, or even inflation that's going to start to move higher based on year over year base effects. But that's not enough. That's not enough to get the 10-year Treasury yield up towards 2% or even higher than that. We need another catalyst. What we need to see is that this global reflation trade is starting to take hold someplace else. And I don't think the reflation trade is over. I think it's just transitioning from one region to the next. So in the first quarter, it was all about great data surprises in the U.S., and that strengthened the U.S. The second quarter might be surprisingly about Europe. I think that Europe, just based on how the vaccines are starting to get rolled out, you could see dramatic improvement. Remember where the U.S. was in mid-January, right? The vaccines and the virus count was really bad. A month and a half later, things got a whole lot better. So the point is that things can turn really, really quick. And what we're looking for is the next big data surprises. And those data surprises may come out of Europe. So investing, so what we're pointing towards our investment is really looking more towards Europe and trying to find value in places that have maybe been left behind or lagging. And then later, maybe in the third quarter, turn it over to the EMs. But I think we have to think of this as sequencing. So that's the way that we're thinking about this from an investment perspective and throughout the cycle.
Jim, to bring back to the U.S. for just a second, I'm sure we've asked you this before, but I always like to know, where do you see 10-year yields by the end of the year?
So I would see them around 2%, because I think that global growth is going to be strong. I think that the global reflation trade continues to move. I think that inflation, will be transitory, but we are going to have a big surge in the second quarter, and it might stay stickier at higher levels, maybe around 2%, the low 2% levels. In which case, it would make sense that the 10-year Treasury is somewhere close to that 2% range. It's going to be a little bit choppy. It's going to range around a little bit, but I think that, and we may even overshoot 2% a little bit. But I think that a good settling point is around that 2% mark. And the key here is that how fast will the Fed start hiking interest rates? And that's what you mentioned earlier, Julie, is does the market believe the Fed? If they move up their policy rate hikes from, say, beginning of 2024 to sometime in 2022, then yields can go a lot higher. But as long as they're true to their word, then it's going to be hard for 10-year Treasuries to get materially above 2% and stay there unless there's a change in Fed policy or there's a big inflation surprise.
A lot of unknowns still, even as much as they try to map it out. Jim, thank you so much. Always good to get your perspective. Jim Caron is Morgan Stanley Investment Management Fixed Income Portfolio Manager. Appreciate it, Jim.